Welcome back, viewers, to FinMeUp Conversations. I'm Travys, the CEO of FinMeUp, and I'm joined today by Wessel Grobler of Fairtree, who's going to unpack a bit of sort of current economic conditions, both locally and abroad, and the impact on our clients' investments and help us understand a bit better on how to manage the volatility that we're currently facing, and give us some forward-looking views and how best we can maybe, de-risk for our clients, I suppose. Wessel, maybe we just start off with a bit of a background, intro to yourself, where you come from, what you're doing, and then we'll get into more of the economic discussion.
Perfect. Thank you. Thanks for having me. It's a pleasure to be able to join you guys today. So myself, been in the industry for roughly going on 11 years now, and kind of the same time with Fairtree. Prior to that, a little bit of an accounting background, but kind of been shaped and molded in the industry within Fairtree. I think quite unique within where we sit and what we do is kind of bespoke stuff. So Fairtree has got a lot of flagship entry points into different asset classes. We look a little bit different in terms of trying to solve a little bit of a solution and a problem for clients to say, how much do I put where? That's often the question. And so we try and answer that to the best of our ability. But yeah, I've been enjoying the journey with Fairtree. It's been a great 11 years, going on 11 years. Strong culture, strong teams, real amazing environment to be able to operate in. So
cool, thanks, Wessel. Yeah, and I think just for the viewers as well, just some more context around our partnership. We've partnered with you guys from an asset management perspective, and longer term, which we won't share today. However, you've been tasked with executing on our investment strategy, our model portfolios for our clients, and really kind of the ones that are making the money make money, right? So,
sure.
So yeah, just for more context. Great. So I think if we could start just with the current sort of happenings locally, abroad, what should our viewers be looking at? How is it impacting? What are you seeing in terms of different asset classes and returns, etc., the impact on it, volatility? Just a broad overview, I suppose, and what also, I suppose, as a second part to that, what our clients should be ignoring as well.
Sure. I think maybe the backdrop is it's obviously intensely volatile. Ironically, by the time you put this out in the market, things would have changed again. We've seen some of kind of the top 99 percentile moves in markets for like daily swings, so between down 10%, or it's been quite crazy. Obviously, it's mainly driven by geopolitical environment. Iran conflict is top of mind, but prior to that, you've had ongoing conflict, Russia, Ukraine. It's kind of just evaporated from a lot of people's minds, but it's still there. Some of those things have impact on energy prices that we kind of feeling today as well.
Like oil as well.
Oil is a massive thing. And then we, as a kind of emerging market, we kind of just catch along whatever happens in the world. So we're very small. I think we often have a very patriotic way of looking at our country, which is good. But from an investment perspective, you want to look at diversifying. We do have companies that do generate income offshore, which is good. But that's also true for a lot of globalized companies. So if you think about the big stocks, the Apples, Amazons, Meta, all of them, they do generate offshore revenue. It's not just linked to the US economy. So things are very much interlinked and intertwined. The current environment is tough to navigate if you look at it very short term. I think the other challenge today is we're sitting in an environment where information is quite high frequency. And so there's a lot of news, very
instantaneous, right?
And
it's right there all the time.
Accessible to everyone. Guys need to pay more attention to Trump's tweets than a Bloomberg screen,
Yeah,
as an example.
exactly.
And so you have to kind of separate those things from a macro environment that drive a lot of the moves. Like kind of March, the big drawdown that we saw in March was one of the deepest in a while. And that's been driven by macro environment. So if you believe in the fundamentals of why you choose and invest into companies or asset classes, it's often also opportunities to buy in if you look through the noise. And so if you feel that there's some upside that you can take advantage of, it's actually a great buying opportunity. But you have to have done the work prior to. It's speculative if you do it in the moment, and you want to kind of separate fundamentals versus speculative investing. So fundamentally, something needs to be driven by a potential upside, generating a revenue, it's got some free cash flow yields, it's got a good PE ratio, some of the things that might play into the playbook of a different portfolio manager. Those things, if they come under pressure and it gives you opportunity, it's time to buy. From a client's perspective, zooming out, it's important to look at diversifying. You have to know that you don't carry any single asset class or single stock risk in a way. Therefore, at least be able to bear a bit of the grunt of some of the volatility, depending on also where you're at in your life stage.
Sure.
Also makes
Yeah,
sense.
of course. Yeah, I mean, let's say if we focus, well, I suppose just following on from that, just a question in terms of the Fairtree, the asset management and how you guys have either rebalanced, what the strategy has been to kind of mitigate downside risk for, let's say based on, the macroeconomic impact locally. I mean,
locally, so I think actually, depending on your portfolio specifically, I think the majority of the portfolios that we look at in partnership with what we do with you guys, I think that's the more relevant question then, is to say the majority of them are driven by your regulation. So people are contributing towards retirement. And I think the majority of your clientele is in that space of like, I'm accumulating. So I'm still contributing towards, I'm accumulating phase of retirement or discretionary capital. And there's kind of parameters that set out in the regulatory framework that allows you to go up to a certain amount in certain asset classes.
Reg 28, I mean,
exactly.
Regulation 28 ultimately.
So that drives a lot of the portfolio construction from that level. And then you want to make sure that underneath you kind of speak to the different risk profiles. So make sure that clients that have an appetite for high risk is rewarded for that risk that they take on. So they need to be exposed to growth assets. As an investor that would then contribute on a monthly basis, it actually plays into the kind of environment where it's to your benefit. It doesn't feel like it, but indirectly you're paying cheaper for the same asset.
Yes, exactly.
So if there's a bit of a drawdown, it's actually to your benefit.
Yeah, because
you're buying cheaper.
Which I suppose over time is going to appreciate in value anyway, right? When we rebound.
That's the thing. So in essence, what you have to ask yourself in an environment like this is, has the asset class, so equities in its current form, structurally re-rated to an extent that it will not do what it has done in the past? In that to say, not that the past is a perfect forecast for the future, but indicatively you're supposed to be able to be rewarded for the risk premium that you're paying buying equities.
Sure.
And so do you still believe that there's a risk premium in buying equities and therefore I need to be rewarded? So we believe that 100% that the asset classes in its form will give you the reward that you take on in the future. So if you're high on the equity spectrum invested, you will be rewarded in the long run. In terms of rebalancing, it often happens on a sub level. It's very difficult to rebalance portfolios timelessly within within funds, one fund selling, one fund buying into another. You want to make sure that your work is done as an allocator, capital allocator, to the underlying strategy to an extent that that manager has got the capability to then go and rebalance into the different securities. So you selling off, an example would be if you got it perfectly right, which most probably no one would have, during March, the only place you would have been able to make money was buying oil, some form of ETF or some form of exposure. Any other asset class, except for something like Sasol that bounced because of oil, came crumbling down. So it was in gold, palladium, platinum, all of the precious metals came down. Stocks were hit hard. People perceive the risk, or it's a risk environment. So then it's risk off, meaning people taking money out of equities. And therefore, to be able to navigate that short term, it's very tough.
Yeah.
But it's already kind of bounced back a big portion of it. So
Okay.
often it's better to do nothing in that moment if you have already allocated to something that you feel has been stress tested in the past.
Yeah. So I mean, no emotional
Yes.
rash decisions in the moment ultimately. I wanted to ask, just in terms of if you can draw a comparison to historical events and what you've seen performance-wise in your funds. I mean, obviously, in terms of the FinMeUp Fairtree partnership, it's relatively new. So for our viewers and clients, a practical kind of example to say, like, well, like you said, the drawdown in March was quite a large one. What is the kind of recovery time? What time frame are we looking to recover, and then maybe draw a comparison. So when the Ukraine war started, and we had this sort of similar kind of downturn in the markets, or whatever the case was, what kind of time frame are we looking at here? Just to try and instill a bit of calmness, I suppose, for those that are more emotional in their decision making, and they're knocking on the advisor's door every day saying, listen, I'm still down,
Yes.
what's going on.
So I think the psyche of the investor is quite important here, and like you mentioned, that is a tough question. It's also tough to compare this specifically to a past event. I think one of the main drivers at the moment is the rebound at times can be very sharp. I think just one of the things that most people relate to is the COVID event. So kind of a deep drawdown, very sharp recovery, massive intervention from central banks across the globe. And so there's multiple elements that play a role in what that recovery looks like. So currently what's going on, we kind of in an environment where we were saying there was a uptick in terms of economic activity within the US, still relatively strong. Consumer is relatively strong. Unemployment is relatively strong. Some of the data signals were mixed because you got kind of your unemployment rate got influenced by the big move to get kind of illegal foreigners out of the borders, and so you've got people in the market, but then it seems like things are moving, but it's actually just a kind of correction in something that has been wrong. So there's data points that would kind of speak to a recovery, but it can be false signaled. So I think probability wise, what I would say in this environment is your global equity from a Fairtree perspective would have been hit hard by your software kind of pinch in the last while. So your view would be that there's no value in those AI software companies.
Tech stock, basically.
Tech stock, which we believe is kind of, I think, a false narrative. There's still legs in it. And so the companies that were hit hard. So I think that will play out. Then there's also the question of the energy prices and the influence of some of these kind of AI-driven environments. So people forget that it takes energy to be able to generate some of these kind of AI endeavors and all of those things. So energy prices do have an influence on some of these things. But then you look at the local market, we're subject to a lot of things in our environment. NASPA's process will be very similar, exposed to some of the big tech stocks. Your banking environment will be exposed to your interest rate environment. Your retailers will be exposed to your current economic environment. And so the retailers most probably will take the first hit because of inflation potential coming through, consumers being less so positive in terms of spending money. Then it's all dependent on what the central bank does, Reserve Bank does with the interest rate environment. And so there was this kind of idea that interest rates are coming down. Now it's like, no, inflation might be coming back. We have to be cautious. So now some of the central banks have actually moved from a cut to a hike. So it's very, very fast at the moment.
And uncertain.
Exactly. And so the road to recovery is massively linked to what your probability would be on the outcome of the Strait of Hormuz. So what's happening in that environment currently, I think your probable outcome would be that it's been countered blockade with blockade.
Yeah.
So now we need to see, is there intervention from the UN at some stage? Does it become an international kind of endeavor to clean up the waters because of the mines that Iran has planted?
Mm-hmm.
So that probability sits roughly in, like, let's call it a 40 to 60%. On the kind of best case scenario would be that Iran says, okay, we open to negotiations again,
Mm-hmm.
and we're going to clean up the waters ourselves. Although if they do say that, they've even admitted that it's tough for them to know where they've planted some of the mines. So
Yeah.
the first ship can come through and been blown up, and then it escalates everything again. And then some of the allies and the partners in Israel. So it's very multi at the moment.
Yeah.
The East has got a big influence. So Asian companies, or Asian landscape. So China,
Yeah.
Taiwan, they all want oil for them to continue, and they're big takers of oil. That kind of equates to, that Strait of Hormuz equates to like 20% of oil supply in the world. So depending on where you put your probability on how long this will take. So let's say, I think the base case scenario would be anything between 4 and 8 months. It does create a supply shock.
Yeah.
There's some kind of intervention, potentially looking at some reserves for countries that do have, that can continue. The US is not subject to this because they net exporters of oil, so they don't really care that much, although they might care to take hold of global oil supply in total.
Yeah.
That's kind of another extreme case that can be put out there. And then kind of the worst case scenario is to say it could be up to an 18 plus month period if there's an escalation in the conflict and it doesn't really get resolved, and there's just kind of this closing down of the strait for a longer period. So the recovery rate is often linked to this environment is driven by macro.
Yeah.
So recovery will be driven by macro.
Okay.
Fundamentally, it's different to answer, but this is
No, sure. I
event.
mean, I suppose it also just depends what your portfolio or portfolios or how they're constructed, right? Like what exposure have you got to equities, like you say, high exposure, especially offshore.
Sure.
Fine, you're going to take a longer tank, right?
It's going to have to.
Yeah. I suppose, and maybe sort of as a last question, I suppose, on the current climate, more positively, if you could put a positive spin on forward-looking, what should our investors be looking out for? What should we be looking out for? What can we look forward to, if anything? And hopefully there is at least one or two. So,
sure. I like to be someone that does look at the positive side of things in general. I think if we look at historical data, it tells us that through different geopolitical kind of conflicts around the world, roughly 7 of them, there's been a recovery that's been relatively strong in the equity markets, because as soon as the pressure lifts, there's a lot of mismatched pricing that needs to come through. It does create kind of an open gate. So you look at strong performance. The one thing that we just need to keep in mind, I think, to dampen that a little bit, just from an expectation point of view, is to say there's still decent upside in the global economic environment. But we need to remember that there's, prior to this conflict, we had the tariff war as well, which had a bit of an influence prior to this. So the re-rating of some of the stocks have been not as deep as would have happened in normal geopolitical environments, but they were re-rated slightly because of the tariffs already. So the rebound might be just a little bit slower, but potentially then more sustainable because more realistic. So I think if you are an investor that does have cash, this is a buying opportunity.
Yeah.
If you are an investor that's already invested, hopefully you've made a decent choice in where it's invested, and therefore you've got trusted people looking after your money.
And stay put.
And stay put, and don't do anything. And if you're contributing in some form of an RA, that means you just keep on doing what you're doing because this is pricing power in your favor.
Yeah. Okay. Great, Wessel. Thanks. I mean, it's been great having you on to give us a bit of in-depth insight into what's happening out there. And I mean, for our viewers, like I said, we've partnered with Fairtree. We've got some interesting portfolios in the works, and very welcome to get in touch with us.